Welcome to our regular 6-minute strategy entitled Is Now the Time to Buy Japan? Having been the poster child for Asian equity performance in the 1980s when I started in the industry, Japan's asset bubble in real estate and equities finally burst in 1991. What followed was almost 3 decades of deflation and a vicious derating of the local equity market. This saw Japanese equities fall from a staggering 44% of the world equity index to just 6%. A salutary reminder, I might add, for passive investors today as they track the current technology boom. There is, though, increasing evidence that Japan may finally have broken this deflationary cycle. Wages are climbing, corporate pricing power is improving, and after a collapse in the yen, exports are highly competitive. For us at Saracen, there are also powerful thematic drivers. The market has some unique exposure to robotics, automation, healthcare, support for an ageing population, smart buildings and electrification. Let's see what these opportunities look like against the risks for your portfolio in the slides ahead. Let's begin by looking at the history of Japanese inflation in the left-hand chart. What you can see straight away is these spikes above 2% occasionally, but also long periods of deflation in the early and mid-2000s. In fact, the average rate for inflation over that entire 30-year period was just 0.3%. On the right-hand panel, you can see this compared to other countries in G7. I've set at 100 inflation for these markets, and you see that in the US and UK, prices broadly doubled over that period. Japan, they rose just 14%. So you can see this extraordinary outlier. So what's the position today? Well, aggressive reflationary policies are starting to make a difference. First of all, the yen is extremely weak. This is pushing up import prices and helping accelerate exports. Actually, at 144, it's close to the 150 level that the Bank of Japan intervened in the autumn of last year to buy yen. So the possibility of a strong recovery is there. The yen is exceedingly undervalued. That red line is the fair exchange rate under purchasing power parity as calculated by the OECD. They think the yen should be at 92 to the dollar, somewhere close to the famous economist Big Mac index, which measures the price of a burger in Tokyo and in the US. They also calculate the yen at somewhere around 43% undervalued. In the right-hand panel as well, you can see what the Bank of Japan has been doing in this respect. They've been gradually loosening their vice-like grip on the levels that the 10-year bond can trade at. This is to keep a reflationary pulse in the economy. They've just widened those again to round about 1%. They're going to be flexible within that. But you can see at last Japanese bond yields beginning to normalise. What's happening in the real economy? Well, some big changes. In the left-hand panel, you can see finally Japanese wage negotiations are pushing up wages across the economy much more aggressively, at around 3.5%. This is a huge change for the sub 2% wage gains that we saw consistently through the 2000s. On the right-hand panel, I've measured the percentage of companies hiking prices compared to the percentage of companies reducing prices. And you can see really that for this whole 30-year period, price reductions have been the norm. Indeed, we had Shiseido, the cosmetics group, in the office recently. They said they couldn't remember the last time they put prices up until today. And you can see that sharp spike up there to a net 30% of companies increasing pricing. This is very significant. Now, the whole economic recovery is not without challenge. One of the key ones is demographics. First of all, that left-hand panel, the red line is births in Japan, the blue line is deaths, and you can see those reversing, and the population actually starting to shrink over the last few years. On the right-hand panel also too, you can see what's likely to be the huge surge in workers aged 65 and over as the working population shrinks. So they're going to have to work harder to counteract that. What are they doing? Well, first of all, they're bringing in more foreign workers, finally. And you can see in that left-hand bar in this chart, total foreigners are a percentage of the local labour force. Now, at 2.65% is still a low number, but that's more than doubled over the last 10 years. Other ways Japan is opening up as well. I've shown on the right Japanese arrivals of total foreign visitors as tourism takes off. Now, obviously, we had the dip over COVID, but that's a very different picture from the economy 10 or 20 years ago. So what does all this mean for markets? Well, first of all, let's look at the history again. Japan over 30 years has been a serial underperformer. As I indicated when I first spoke to you, it reached almost 45% of world equities and then collapsed to just 6% today. And you see how it's done at that huge underperformance of the MSCI world over multiple years. But it's attractive today on valuation. On the right-hand side, you can see the forward multiple about 14 times. That compares to around about 20 for the US. Perhaps most significantly, though, we need to look at the price-to-book ratio, which at just 1.2 times is exceptionally cheap. It compares to almost 4 times for the S&P 500. Indeed, 46% of Japanese listed companies actually trade below book or break up value. So what does this mean for policy? Well, first of all, we're considering short-dated Japanese bonds to take advantage of that extraordinarily undervalued currency as policy normalizes. In equity markets, we're attracted to value, yes, price to book and even yield, but particularly to the powerful thematic trends where Japanese equities are so strong: robotics, connectivity, managing demographics, diet and nutrition, smart buildings and electrification. All this is being supported by strong foreign investor interest. It's not, of course, without risks. A disorderly surge in the yen will bring back the risk of deflation. Military conflict over Taiwan or in North Korea particularly impacts Japan. And yes, demographics in the longer term are very challenging. But today the markets look attractive, and we think it's time to bring Japanese equities back into your portfolio on a mainstream basis. Thank you.